Hey, welcome back to the channel, folks. It's been a while since I've done a live stream, and I am back from vacation, but I am still kind of sick. So I may cough a few times during this live stream or blow my nose or something. I'm not back to teaching jujitsu yet, but I'm not feeling so terrible that when I went through the grocery store today and I saw this Green Flash electric cruiser beer, based on the viewership of my channel. I decided I should probably crack one of these open or two of these open during the live stream today. And so let's have a drink of Electric Cruiser IPA by Green Flash. If you guys know anything about the California beer industry, you know that it's pretty heavily weighted towards IPAs, especially in San Diego. Has to do with the environmental conditions here. But anyway, I am ready to talk to you guys about anything in the economy that you would like to have a word about today. I have been a bit disconnected over the last 2 weeks or so because I've been on vacation, and it was the first real vacation that I've taken in years where it wasn't to go visit family or something like that. So, Shoeless Joe says, um, "Hey man, good holiday. Where'd you go?" I actually went to Colombia. This is somewhere I've been to once before, but like 25 years earlier when the conditions are much different. I would say now that Colombia should be a premier vacation spot for anyone, family, or just traveling by yourself or whatever. It was actually a great vacation, and I suggest that. I went to Medellin and to Cartagena, plus and minuses to both cities. But hey, I always manage to enjoy myself whenever I go somewhere new. I learned to speak a lot more Spanish. I could basically carry on a conversation now, so I'm pretty happy about that. So, yeah. So Colombia, if you guys ever get a chance to do that, go on a vacation to Colombia. I'm gonna take my first sip of my beer here, and honestly, it's not bad at all. Not bad at all. Um, Fred C says, "Hi, Jason. The feed is pretty choppy. Are you guys able to hear me okay, or is it just the video that's choppy?" So yeah, let me know if you're able to hear me okay, because it's really the sound that's super important in the videos. Okay, so all right. Anuj Gupta, let me see here. Says, "Hi Jason, what do you think about the bottom of the S&P 500, and how will the housing market by the end of the year?" Well, I expect the housing market to absolutely get crushed by the end of the year, and that's simply a matter of mathematics, right? As interest rates start to rise and the cost to borrow money starts to go up, it's going to push more and more people out of the market. I think we're already looking at somewhere around what is it, 2.16% rise in interest rates. In fact, just since the beginning of the year. In fact, I was just looking at an article about this. Let me add this to the screen here, and I'm going to move my screen a little bit. So if we're looking at a bottom for the S&P 500 here, I think we're pretty close to where the bottom is going to be. I think my a revised estimate a few weeks ago was right around 3,600. I think that we stay right around 3,600, that this is pretty much the bottom. We're going to bounce around it for quite some time, probably between now and the end of the year. So certain fundamentals of the economy look a little bit better than the media would have you believe. Of course, we are at pretty close to maximum employment, and even though layoffs are starting, the reports is that people are fairly easily able to find jobs that are replacing the amount of income they had before, or in some cases, they're actually getting a better deal because there are a lot of companies out there that are desperate for talent. And as I was flying, and I had a nightmare trip trying to get where I was supposed to go. I left on the first, ended up getting there on the third. So it was 2 days, full 2 days of travel. And the refrain that I heard constantly from the older flight attendants was that nobody wanted to work. And I start conversations with everyone, folks. And the thing that was going through my mind is that we're at maximum employment. There's about 1 million people who were in the workforce prior to COVID who decided not to come back. Most of these were folks who were over 55 and were able to retire early. And it's not that nobody wants to work. It's that the folks that would normally have worked in a job that was exploitative, that had poor working conditions for young employees like flight attendants, they really are exploited and treated very poorly in that industry. They found other jobs to do during the pandemic, and now it's difficult to entice them back unless you increase their pay, which is going to increase cost for businesses. So the issue wasn't that no one wants to work; it's no one wants to work for crappy pay, poor benefits, and to be treated poorly where they work. So definitely one of the things that I saw when I was traveling, I had 4 canceled flights on my way to my vacation spot. So so I think that this is still a positive in the economy. They were close to maximum employment. The goal of the Federal Reserve, I know they came out today and said, hey, we're not trying to cause a recession here, but they do want to see mildly higher unemployment than we have now. They want to reduce pricing pressure. They want to reduce demand across the economy. And they're doing that by increasing borrowing costs. That is most notably happening right now in housing, of course. And it's getting more and more difficult so they've loosened lending requirements, but the cost to borrow money has increased by 20 or 30%. And let's take a look at that. I think I just looked at this earlier. It said this is from Barron's. This is behind their paywall. The average rate on a 30-year fixed loan rose 0.55 percentage points to 5.78%. So, 5.78% versus 3.78% a few weeks ago literally raises your borrowing cost by somewhere between 30 and 40%. It's going to cost you 30 or 40% more per month in order to get into that home, which is pushing a lot of people out of the homes that they wanted to originally purchase. They're not in that market anymore. They're going to have to buy something smaller. They're going to have to move into a condo instead of that 4-bedroom, 3-bath house. They're looking at that 3-bedroom, 2-bath house. Or for a lot of folks, that may have pushed them out of the market altogether. So I think that's fairly obvious at this point that is one of the goals here. So this says the rate on the 30-year loan has increased 2.67 percentage points so far this year through June 16th. And it's the biggest jump in the history of Freddie Mac's survey over that period, over that 30 years, according to Dow Jones market data. So, yeah, I think that we are looking at a distinct crash in housing prices here coming pretty soon. I don't know what that means for everyone out there. Because I don't have any money borrowed against my home or anything like that, it will mean almost nothing to me. But for a lot of folks, it will mean something. So this is pretty interesting here. If you're looking at this trend line right here, the only asset class that is above water since the beginning of the year has been energy. And at this point right now, we are looking at that only being about 41% over. It's down from from roughly 66% from the beginning of the year down to about 41% from the beginning of the year. So even oil has taken a bit of a dive. So I actually still fully expect oil prices to hit about $150 a barrel just on the basis of the options market. I think it'll probably hit about $150 a barrel by the end of summer, and then we'll see a crash in oil prices. So in terms of pumping right now, we are really close here in the United States to back to record levels of pumping. If you guys have TikTok, the best source, one of the best news sources for analysis on the oil industry is a guy named Mr. Global 2, Too, on TikTok. So I don't know him personally, but I know of him from the oil industry. He literally is one of the world's foremost experts on oil markets. And I actually find it hilarious when people argue with him through the comments. Nobody knows more about the oil industry than this gentleman does. And if you want some quick and concise videos about how the oil industry works, you might want to check out his channel. And that is Mr. Global 2. And that is MR and then GLOBALTOO. Like I said, not somebody that I know personally, not someone that I have a business relationship or anything like that, but he is well known in the industry. Wanted to remind you guys that the super chat features are on. I said super fat because I've been on vacation for the last 2 weeks and I feel super fat. Anyway, so I'm going to get to some questions here. It looks like everyone can hear me fine. Looks like the feed is okay. And let's start with the big one. Are we in the capitulation stage of the stock market cycle? Probably not quite yet. That's something that has been discussed for a very long time in terms of the market cycle, meaning for the last 2 months or so. I see us bouncing around 3,600 for the next few months before we really start to see a turnaround. This is an opportunity for you folks to dollar cost average into stocks. I think when I left to go on vacation, my upstart stock that I was working a position into had gotten up to about $50 a share. Now it's back down to about $34 a share. So I'm looking to start buying a few more of those shares as we go ahead. Looking at Square right now, it looks like a good place to start dollar cost averaging your way into Square. Their business model is in no danger of failing at this point. They really are tied to cryptocurrency right now in the way that they probably shouldn't be at this point, even though I know they're making that switch. That's not where the majority of their revenues are coming from. So Florin Vraby says, hello, and you're always one of the folks that is on my live stream. I want to say that you are from the Netherlands. I don't remember exactly, but yeah. So are we at capitulation stage right now? I'm not sure that we're at the textbook capitulation stage right now. We could have some ways to go. But yeah, what is your view on Etsy? So I don't actually own any shares of Etsy. And I sold my shares of Shopify back in I think back in January when they hit about $1,400 a share. I just didn't see them going any higher than that, and I saw not necessarily threats to their business model, but I saw kind of leveling off, and perhaps that they were vastly overvalued. I didn't have a ton of shares of Shopify either. I don't necessarily put them in the same category. They are definitely going after different target markets. I think Etsy, as far as a stock goes, gives you pretty much the only choice out there as far as how to invest in that type of market. And it's really the only marketplace, the only grand marketplace like that online, at least available in the United States. So I think that is something that we should keep an eye on. I don't know what their valuation is like right now. Let me take a look at that real fast. It's been a while since I've actually taken a look at them. So let's look at price and volume today. Okay, I didn't realize it had gotten quite so low here from its high a few weeks ago. About almost $300 a share. Look, folks, let me remind you, I'm feeling a little bit sick today, but I do think that Etsy's been on my radar for a while. Their business model is not something that I pay that much attention to just because I'm not interested in that type of product. But it's always smart to look at things that you're not all that interested in because you want to make sure that you're not really missing out on a piece of the market there. So in terms of an entry point, of course, because it's down so much, that looks really, really good at this point. It looks like Etsy's at $69.98 a share. I don't know if that's the closing price right now, but that's what I'm showing. It looks like a significant decline. But I need to compare this against some of their financials. If we take a look at income statement here over the last 12 months, and I don't know why it's taking so long to load the data here. Okay, so we have good amount of data here coming through here. Selling general manual expensive, 19 million, gross profit, year-over-year growth at 9.86%. That is a bit disappointing. Year-over-year growth at 9.86%. And we have declining growth now, it looks like since first quarter of 2021. So some decline in growth since first quarter of 2021 would be expected. The fact that it dropped so precipitously from 164% down to 9.86% to first quarter of 2022 is a bit concerning. I'm not going to lie to you about that. So in terms of their expenses look relatively flat over the last year or so. So not terrible here. Earnings before taxes. Okay, earnings per share items. Let me see here. All right, so nothing terribly alarming other than the fact that their sales growth is declining. So how mature is this company? That's what we really need to decide. If we're looking at a retail, e-commerce platform on the internet, what is their ultimate sales growth trajectory going to be like once they're a mature platform? And is Etsy a mature platform at this point? These are the questions we need to consider. I think what would be acceptable is comparing it to, to brick and mortar retail growth. If we have the same level of in-store sales growth that you would have on a retail basis in brick and mortar in what's supposed to be a more efficient operation online, I think that would be acceptable and probably looking at something around 15%. So I would wait until next quarter's numbers. And I want to take a look at this year-over-year growth in terms of profits, year-over-year growth in terms of revenue. So revenue growth is in line. Profit growth is not necessarily in line with what I'm looking at right now, but it's a single quarter. So let's take a look at what things look like next quarter. This could be a lot a result of investor confidence kind of dropping off the cliff here. So, and let's talk about that. Investor behavior is changing a bit. People aren't spending any less, of course, because of what's going on in with inflation. So I do want to take the time to address a little bit of something about airlines. So the airline industry, Shula's Joe says, we got some flight chaos in the U.S., especially on the smaller airlines. When I left on June 1st, the flight chaos was unfreaking believable. There were people sleeping in airports everywhere. They had been there for days. I had sort of a special ticket that I had, so I knew there was a possibility I could get bumped from flights anyway. But it was actually 4 canceled flights, and I had to pay a little bit extra to get where I was going. And yeah, so it was absolute airline chaos. But let me remind you that while there have been a few bright spots in the airline industry when it comes to investing, this is the big kicker. When the airline industry as a whole is examined, it is not profitable, right? This is a business that is not run in a way that really reflects capitalism. If it were so, then every single one of these businesses would have gone out of business. Every 10 to 20 years or so, the airline industry has to be bailed out. And that's because of their aggressive pricing structure. It's because the general public is generally not paying what an airline seat is actually worth. And it's the business traveler that is really bearing the expense. I'm not talking about people in business class or first class, but it's just the business traveler that has to make arrangements at the last minute that is really bearing almost all of the expense of traveling. And that is one of the reasons they get treated so well, because they're the ones that are actually creating the real revenues for the company. And all of us that are riding coach and paying $600 to fly to a foreign country that's 15 hours away, we're not actually really paying for the entire cost of the seat. We are being subsidized by those business travelers. So yeah, Tom Liu says, let's take a look at Melly. So yeah, let's take a look at that. Once again, this is a company that it's very hard to say no to this investment, especially after the decline so much here in the last year or so. Mercado Libre is a huge e-commerce platform through all of Latin America, and I think it's definitely worth taking a look at if this is not part of your portfolio. Hold on a second. Like I said, folks, still a little bit sick here. Yeah, I got sick on the plane. Not sure exactly what happened, but I've had a little bit of a cold. It's not debilitating or anything. I tested negative for COVID, so we're all good. Again, here, I wouldn't say on paper this looks like declining revenues over the last couple of months. I wouldn't say that's statistically significant yet. If you look at their revenues, tend to bounce around a little bit here. Their costs tend to be, cost of revenues have remained relatively flat. Gross profit, gross loss looks fairly good. Year over year growth, 75%, pretty solid. I think if you were, now it's not the same investment to look at Etsy and Mercado Libre. It really isn't. But if you are looking for a little bit of diversification, especially international diversification, Mercado Libre might look like a fairly good choice right now to take a second look at. I think you should. So once again, folks, as a licensed professional, you cannot accept anything that I'm saying over the internet, of course, as individual instruction to buy, sell, or hold any security. You have to do your own research. I would say that Mercado Libre, though, it's probably worth taking a look at. All right. It's a solid business. Anush Gupta says, when do you think the Ukraine war will end, and does it still affect prices that much? Yeah, it's still affecting prices that much. Is it affecting the price of oil that much? No. What's affecting the price of oil, or not gasoline, is if you look at the standard analysis of the oil industry based on what the price of oil is, what should the price of gasoline be? At the beginning of the year, the price of gasoline, and I did this calculation at the beginning of the year, should have been about 3.02 per gallon on a national basis. Right now, it should only be about 3.68 per gallon, like $3.68 per gallon right now, based on the price of oil and what it costs to manufacture oil. This is a pretty standard calculation that folks do when they're looking at the oil industry. So the president made a speech while I was gone where he was both wrong and he was both right about many different things. We are pumping more oil now than we have in a long time. We're really close to record levels. We've had massive growth in production over the last couple of years, and actions of the oil industry and of the futures market have pushed the price of gasoline up to north of $5 a gallon in a lot of states, and it's north of $6 a gallon out here in California. Those types of regimes come to an end at some point. That futures market will have a crash, just like it did in 2008. We didn't have a shortage of oil in 2008. We had a futures market that was starting to go crazy, and it hit, I think, $147 a barrel for oil sometime in, I think it may have been August of 2008 before it started to crash. We're likely looking at a situation like that again in August of this year, getting close to $150 a barrel, and then we see a precipitous crash, probably back down to the $80 per barrel level, and we'll see declining gasoline prices as we go ahead. But no, the oil industry is not simple. There's no single cause. A lot of this has to do with supply shock. And a long time ago, maybe a month ago, I did a live stream where I went through kind of the history of the last 6 inflation episodes that we've had. And 5 out of the 6, it was due to supply shock, meaning just a massive increase in demand after, World War II, right? Panic buying right before the Korean War, relief buying right after the Korean War. And almost all of that was due to supply shock, just people going out and buying shit because they thought it wasn't going to be available in the future. Some of that is happening right now. There's just not enough. There aren't enough bodies, and there isn't enough production to meet demand, and the price of everything is rising. If you want to combat that, stop buying things. It's really that simple. So, yeah. So Chris says, if everything is mostly down, where does the money go? Cash or bonds? Actually, so money, we are starting to see cash flows into bonds at this point, which doesn't make a ton of sense to me because interest rates are still going to rise. And no market has been hit harder this year than the bond market has. It's not supposed to see these sort of gyrations, and it is. And this is really providing a once in a lifetime opportunity for bond traders to make some serious long-term bets. Yeah. So, the other question is, when do you think that the war in Ukraine will end? Not anytime soon. So I've tried not to take a position on, it's been pretty obvious that I'm pro-Ukraine here. I'm aware that Ukraine is a flawed democracy. I'm aware that it was basically a banana republic before all of this started, and that it was exceptionally corrupt. I'm also aware that they're a sovereign nation and they have the right to determine their own future. And last week, former Russian President Medvedev and Putin both pretty laid out their naked imperial ambitions, which is they simply want to restore the Russian Empire. And Putin made that most obvious by comparing himself to Peter the Great. So I don't think that this war actually ends anytime soon. I think that it's going to be a very protracted and long conflict. It already looks to a degree somewhat like World War I. Every time we have a conflict now, we get a better view of what's going on the ground. But I'll say one thing: we get a lot of propaganda here in the West, and I don't think it's as obvious to other people of all of the quantitative advantages that Russia has, the deep reserve they have in material in some respects, not all of them, of course, but it's going to be very difficult for the Ukrainians going forward, especially as the West begins to lose interest. As I said before, the West really doesn't have this massive strategic interest or they didn't have before a massive strategic interest in Ukraine. And the fact is that most people couldn't find Ukraine on a map. Okay. I think a lot of that has changed, largely because Ukraine has sort of won the propaganda war on the internet and has ended up winning the hearts and minds of people. How long do we keep supplying them with weapons and cash, right? And how long before that becomes a political weapon in the United States that is used against people running an office and things like that? So, yeah. Elon Ozolan says, welcome back. I hope you enjoyed your holidays. I really enjoyed my holidays. It was the first real vacation, like I said, maybe in 5 or 6 years. So if you haven't visited Colombia, I highly recommend that you visit Colombia. If I speak reasonable Spanish enough to get by and have a conversation, but even I used my Google Translate app. I downloaded the offline library and was able to get along just fine. That AI is actually pretty amazing when it comes to translating conversational Spanish. Like I can write something in English and know if it's translated well enough in Spanish, even if I don't understand the Spanish like 100%, just because I speak fluent French, fair Spanish, and I can tell if it's translated correctly or not. I basically didn't find any mistakes the entire time I used the app, so I was actually pretty impressed. So even if you don't sick, if you feel sick, less than 50 milliliters of vodka, put it in a teaspoon of black pepper, mix it and drink it before bedtime. You'll be fresh in the morning. Oh man. At one time I used to record all of these remedies for sickness, and I have just thousands of them recorded in a journal somewhere. I'll have to take a look at it sometime. So let's get on to a comment here. Patrick Milligan says, I had shares in Electric Last Mile Solutions, which I sold for a big loss after they filed for bankruptcy. Then today it rose 200%, leaving a bitter taste. I'm only trading 2 years and did not know what to do. So Patrick, this company is actually I did a video almost 2 years ago where all I did is I put up it on a screen and I scrolled by the names of 1,600 U.S. automakers that were started between 1900 and 1940 that went out of business by 2020, right? And so there are 1,600 companies or more that went out of business in that time period, and there were only 2 survivors, right? And that was Ford and Tesla. Every other company had gone out of business at that point. And so this is going to happen with a lot of these SPACs that went public. They were pre-revenue, pre-product SPACs, right? Where their ability to survive was going to be based on their ability to acquire funding going forward because they had no products and no revenues. So that was not the case with every SPAC. If you look at like SoFi, this is a company with products and with revenues and growing revenues and a pathway to profitability. If you look like a company at a company like Canoe or a company like Last Mile Solutions, or even Hyliion, which is a company that I kind of like to a degree, at least their business model and their ambitions. These are companies that are a huge risk. At no point were they ever fairly valued. It was all speculative. It's still speculative. You are looking at companies like Xpong and Neo right now. They have products, they have revenues, they have a pathway to profitability. Other companies don't. Like Canoe does not at this point. Last Mile Solutions does not. Workhorse does not. I would avoid all of these at this point. The idea that it popped 200%, leaving a bitter taste, that's going to happen at some point. Electric Last Mile Solutions is not a company that I owned. It's not a company that I covered on this channel. And it's not a company that I probably would have owned. Not because it's that particular company I saw failings in, is that I've already taken my speculative risks in that sector. So if you want to bet on something wider than just owning Tesla or something like that, or you think Tesla's a little too expensive, try looking at a really wide investment in the lithium ion battery chain. Look at those 2 ETFs that I've talked about a few times, which are BATT and LIT. And these are companies that own a piece of the lithium battery supply chain, meaning that no matter what company in terms of EVs wins, these companies are going to be providing them the lithium. They're going to be providing them phosphate, manganese, cobalt, derivative chemicals, battery management technology, something like that. I think that's probably a safer investment at this point, and it's a way to participate in the electric vehicle revolution without taking quite as much risk as buying a pre-revenue and pre-product company, which a lot of these SPACs are. Many of these SPACs went public before they sold a single vehicle, and that is a loophole that got them around the traditional sort of scrutiny that would have gone on with an actual IPO. So yeah. A news script says one of the big factors is cryptocurrency. Also, people lose money there. They're not going to buy anything else. So about 20% of people in the United States, at least, own some amount of cryptocurrency, right? And but it's not a huge amount, and very few people are all in. Right? I know a few people that have gone all in, and of course they've gotten crushed. I haven't taken a look at my crypto account in a while because I'm sure that I've gotten crushed as well. But I never had that much in it to begin with. I'm far more interested in the growth of the technology space itself than in the value of any single cryptocurrency, right? I tend to be more of an Ethereum maximalist at this point because of its utility, or at least its future utility. And I know that there's some Bitcoin maximalists here who are going to disagree with me, but I think that the Bitcoin developer community is just too rigid at this point and too conservative, and they basically kind of look like, yeah, like HP, right? They're the company that's out there. They're going to make revenues, but they're pretty much dead. I think Bitcoin, in a way, could end up being that way. And you're looking at that the Ethereum and a number of the so-called Ethereum killers are going to be where all the innovation happens at this point. So, um, okay, yeah, this is a big question. So, do you think NVTA will run out of cash before they start making a profit? That is a distinct possibility. This is a company that I made a video on them a while back where I just kind of described what the company was, what they did, and how they worked, and the interest that was surrounding them. And then I kept asking in the comments, what makes this company special? And I got a bunch of negative comments on like, "Hey, do your job. You know what you want? Why don't you tell us what makes it special?" And the point of that video was I really couldn't tell what made that company special. And the answer that I got is this is the Tesla of genomics, meaning they're collecting all of this data based on the low price of their test kits, the low price of their technology. They're collecting all this data. The problem is you have companies like 23andMe who have a giant step up in terms of the amount of data that they're collecting. So when you go out and you do a DNA test with 23andMe, the product isn't the ancestry results they give you back. It's not the little health data that they give you. The product is you. Your genetics and your DNA is the product that 23andMe wants, and they want that data to derive insights from interactions between genes, and they can use that and sell that to other companies. And that's where they anticipate their revenue growth going. So these companies really have a long, long period. They're going to be 20-year science projects before they really show any degree of profitability. And that's essentially what 23andMe is. I think they're actually, from concept to today, I think 23andMe is pretty close to being 20 years old at this point. And they've got at least 15, 20 million people in their database right now, just based on, it's not called through lines with them, but their family tree function. Their family tree function has seen a massive increase in, I have a really messed up family tree. And based on the fact that I was adopted, based on the fact that nobody knows each other, but I've figured out pretty much all of the relationships between people. If you have a 1%, DNA relationship with me, I can probably tell you exactly how we're related, who our common ancestor was, and all that. Well, the algorithm now is getting really good at doing that, at creating those insights. Even though, like, I have half cousin relationships with everyone on my family tree. There's a bit of inbreeding on one side of the family where I'm related to both the mother and the father of some of my cousins. So that is one of the things that's going on, is that those insights are getting better and better and better as this company matures over the years, and especially the health information too. So I think that the plan was for them not to make a profit for a very, very, very long time. When I made the video originally, I think Invitae was at $40 a share or something like that. When I looked, the last time I looked, it was like $4 a share. I don't know what it is, but I would not expect them to make a profit in years. I think it's going to be years before Invitae is profitable, and I don't think any respectable analyst would say that. Oh, so it's at $2.13 a share, $2.07 a share. I'm going to take actually a closer look at this company. I've never owned stock in this company either, just through ARKG, but that may be something now where I'm willing to take a longer term risk on that. George Chiotis said, "You've been on my live stream before. My plan for the next couple months is to DCA the day that PCI is announced. I don't think they can go down if rates are lower than 4%. I wouldn't put a target rate on that of 4%. And if you're looking, you're going to DCA in on when the producer cost index is announced. I don't think it's a terrible strategy. I normally just pick a day of the month and let my trades go through then and pre-program everything ahead of time. And I try not to worry about it because worrying about it actually kind of influences your decisions emotionally. And Yeah, so I don't know. And let me look at your list here that you're buying. I'm buying Google, Walmart, and looking into Visa, Nvidia, and AMD when lower PE. I think it's a good strategy at this point. Nvidia is a highly, highly volatile stock. It's one that I am dedicated to dollar cost averaging into. Every single option strategy that I've had on Nvidia has failed because it has been so incredibly volatile. So um, let's. I don't know what price was today. Like I said, I've been a little bit sick. Just got back from vacation. Uh, but Nvidia today, I mean, this is massive amounts of volatility. Down 156 something or $153 a share at its lowest today. Basically all the gains it had for the last year, it's essentially lost. So, but if you watch my last two videos in this company, the future of this company is absolutely massive, and I think it's a very distinct possibility that a decade from now, when we look at Nvidia, it's going to be the largest component of the S&P 500. It's going to essentially eat the market cap of, not eat the market cap, but it's going to eat the S&P 500. It's going to be the largest share of it. So, what do you think on the SPR release? Eric M, can you please elaborate on that? I'm not sure what SPR means. What do you think of Tesla's amounts of increasing prices of all of its cars? Now, I realize that had a little bit of an effect on the price today. I wouldn't look too far into that. I think that people are looking to jump on any piece of bad news at this point and bail out or to create market conditions to profit on some of that. They don't have a choice. It's simply a matter of increasing costs between labor here in the United States. From what I understand, the labor costs that they expected in Austin are actually much higher than they anticipated. Um, a lot of costs are a lot higher than they anticipated. And I think that, of course, they're still having issues with supply chain all over the place. And I think that this is something that always causes with Tesla a bit of a panic when it happens, and people forget about those price raises in a little bit. They're the people that buy their cars are not all that sensitive to price. I think what they're going to be more sensitive to is interest rate movements on their vehicles. And I think that increasing price along with interest rate movements could actually cause a dent in prices. But the average client of Tesla, it's probably a household that makes $140,000 a year. Okay. Um, and if you make $140,000 a year, I don't think you should be buying a $45,000 vehicle. But that is actually the average price of a vehicle here in the United States now. Like if you take all vehicles, it's close to $45,000. It's not this highly priced vehicle that people think it is. Your brain is still stuck in the 1990s and what you think an average cost of a vehicle is. The average cost of a vehicle in the United States is somewhere right around $45,000. So if you're paying that for a Model 3, you are still firmly in the middle class there, but it does mean you're in that sort of upper middle class slice. But yeah, so thank you guys. Just want to remind you again that the super chat features are on if you feel so inclined. So we're going to move on here to Nathan W. What do you think of Micron 52-week low today? Micron is a man, somebody's ringing my doorbell and I'm not sure why. Not going to bother answering that. But Micron is a company that I've had my eye on for quite some time. At one point, I owned shares of Micron and I sold them years ago, and I don't know why. I don't remember why, at least, but it's hitting a 52-year low at this point. And when I look at their financials, let's take a look here. Let's take a look at their financials. And all right, why is my connection so slow today? Okay, so we're seeing pretty steady growth in revenues here. Not a lot has changed. We're seeing we're seeing accelerated growth in profits, which is actually really good through second quarter of 2022. Yeah, this actually may be, just as a quick glance, this may be one of the better choices to get into as I've looked at this time. Yeah, so I'm actually really kind of surprised by these numbers here. When looking at year over year growth through second quarter of 2022 is up 96%. Prior is up 77, 59, 45, 21. things are actually looking pretty good for them. R&D expenses still relatively stable. Admin expenses relatively stable. The total operating income is increasing. Yeah, one of the better choices, just at a quick glance, I haven't had a chance to do a deep dive on them for a while, but at this level, I may look at them too. For this would be a mildly shorter term investment for me, say 3 to 5 years instead of my typical 7 to 10 year minimum investment. This company tends to be volatile and limited in range. So yeah, Brian Lee says, welcome back. I hope you had a great time. The market is very bad. I'm down to less than 25% of my all-time high. Oh, no. Brian Lee, that is simply because you're a technology investor, and technology is exceptionally volatile. If you're going to continue to invest in technology, this is one of the things you have to accept, is that sometimes you're going to get crushed. I'm getting crushed too, along with the rest of you guys. I'm not immune to this. It has not been fun, but it's not something that I worry about on a daily basis. I knew that the market was bad, and I was able to take a 2-week vacation without too much in the way of concerns, because my time horizon is literally 7 to 10 years out. I knew that at some point when I made these investments that this exact thing, well, not this exact thing, but something very similar was going to happen, where every idea that I had was going to turn out to be a bad one for a little while. My advice to you at this point is to choose your companies a little bit more wisely. Look at the companies right now. Like Warren Buffett says, when the tide goes out, you get to see who's swimming naked. And that's really what we're going to see right now. Is you're going to see a lot of companies who don't have the ability to raise money in this time period, either through a secondary offering, through bonds, or through private equity. They're going to go out of business, or they're going to be acquired for pennies on the dollar. And now we're going to get to see who's been swimming naked the whole time. And this is a good thing for markets overall. It's actually in the long run going to be a good thing to a degree for inflation, as some of the excess wealth in the economy is going to evaporate through losses like this. But this is also a good time to pick higher quality companies. A lot of companies are being beaten down right now unjustifiably. Picking the companies that are innovative still, that have a long history, that have products, that have revenues, that have a pathway to profitability. The investments that you make today are the ones that you're going to be bragging about 5 years from now. It's not the investments that you made 2 years ago, right? Some of those are going to get crushed. And I haven't even looked at my accounts lately, but I have what I have been doing is concentrating on quality, and I've actually been putting more and more money into just my more diversified mutual funds. ETFs at this point, and especially some dividend growth funds, which have been a smaller portion of my portfolio. But as I get older, I'm adding more dividend income into my portfolio and really concentrating on that total return, though. What am I making with dividends and with capital gains at this point? So Anush Gupta says Kathy Wood has the right thinking, but for her valuation does not matter. Do you think her stocks will come back? I do. I don't tend to hold all the stocks that she does, but we have similar things here. So we have similar positions when it comes to innovation. But innovation, the history of investing in innovative revolutions has been one of mostly tears and a few moments of joy. And those moments of joy tend to be massive, right? But there's a lot of regret when it comes to picking individual stocks. I think I've talked about a couple of my biggest failures in investing in Lucent Technologies. I don't know if anyone remembers them, but I lost like $80,000 in Lucent Technologies at one point, like when I was like 26 years old or something. And it wasn't until later that I realized that I had no idea what their actual business model was. I'd been influenced by their commercials, and that's the reason that I bought the stock. So, as rates rise, are rate rises really going to work, and what more should the Fed do? So what the Fed is trying to do by raising rates is actually to create a bit of unemployment. And I know that sounds crazy, but they need to do that in order to reduce demand. They want people to be mildly less acquisitive going forward, meaning you want us to buy less crap. Man, there's sirens going on outside my house. I wonder if that was the police knocking at my door. I hope not. Anyway, I'm not getting off the live stream until I'm ready to get off the live stream. But anyway, So I read an article that basically stated that in order to tame inflation back down to zero, that unemployment would have to be close to 8% again. There's no way of creating 8% employment without creating a recession. And then the Fed comes out today, says that they don't intend on pushing the economy into recession. I think the chances of a super soft landing right now are basically zero. It's not going to happen. I think we're already in a recession, meaning we are in the middle of our 3 quarters or more of declining GDP. We will see declining GDP in this quarter. Although I don't see this as an out of the ordinary catastrophic situation, this is simply the end of a credit cycle, meaning that more credit has been basically too much credit has been extended in this market. We're going to see a contraction of credit. We're going to see a reduction in economic growth, and we're going to see a quite normal recession of 3 to 5 quarters of declining GDP growth, and then the economy turns around and is re-stimulated at some point. When that happens, though, the Federal Reserve is actually going to have a lot more in the way of they're going to have a lot more in the way of tools than they had in the past to stimulate the economy because interest rates are going to be higher. They don't want to be in a long-term cycle where we have interest rates at close to zero, like we've had since 2008, 2009. This has not been ideal for the Federal Reserve. They've had to be creative with the tools that they've used to stimulate the economy, which has essentially been printing more money, right? They coordinated with the Reserve, with the not the Reserve, with the Treasury, with asset sales, with asset purchasing, and with issuing of bonds in order to prop up markets. They don't want to be in that regime forever. We're already looking at balance sheet roll off that is having an effect. We're already looking at money evaporating in markets. The velocity of money here that's actually something. Velocity of money is not something I'm going to cover on a live stream today. I'm not up to it because I'm feeling a little bit sick. But that is a subject that I should probably do on a live stream because it's extremely important. But yeah, but are they really going to work? And what more should the Fed do? What the Fed is doing is already kind of working. We're seeing some companies announce layoffs. The labor market is still being able to absorb that for right now, but that's not going to happen forever. I fully expect by the end of the year that unemployment rates are going to push past about 4%. Okay. Oil, $150 a barrel so by March, and then we see decline. We see unemployment rates at about 4% or higher by the end of the year, which is still really freaking good. The 1990s, which were considered sort of a really great booming economy, we had an average unemployment rate of close to 6% in that time period. We had average mortgage rates of close to 6 or 7% in that time period. I think my first home that I bought, my mortgage rate was 9.25%. Okay. And that was because it was my first home when I was 18 years old. So yeah. Telo 666999 says Tesla at 450. Anything is possible with Tesla. It always seems like selling Tesla at any time is a bad idea. Having an option strategy on a really large Tesla's position to generate income off of it may be a good strategy for you. Like I own enough shares to have an option strategy on Tesla, and I've used that to generate quite a bit of income over the last 10 years or so. And I use that to reinvest and increase the size of my portfolio. And I usually do that by covered calls that are sold way out of the money that have very little chance of being exercised. And occasionally I have to eat a loss and unwind that trade because the stock is so volatile that it blows past my projections. And occasionally I got to do that. Like I'll make $3,000 or $4,000 a month trading those options, and every once in a while I got to unwind a trade at 10 or 12,000 bucks, right? So it wipes out 3 months of income. But it's the price you pay if you're an options trader. Is it sometimes you have to unwind a trade if you don't want to realize the gain on that stock, pay the taxes, and risk getting back in at a later at a price where you're going to end up owning fewer shares. So yeah. Brian Lee says Tesla has strong support at 575. If it's broken, anything can happen. Yeah, I'm not a huge fan of technical analysis when it comes to support, or resistance or anything like that. I'm not a huge fan of that just because over time those analyses always tend to break down. But I will say that Tesla has actually been remarkably resilient in terms of this market, especially with the amount of let's just say silly behavior that's going on here. Shoeless Joe sends me a super chat for £5. Thank you very much, Shoeless Joe. First one of those I've received in a while. Hey, Jason, just checking in from Australia. Do you think there'll be an overshoot in rates based on the last 10 years of low rates? uh, I would need to understand what overshooting rates is going to be. Basically, overshooting rates would be throwing the economy into a deep recession because it limits liquidity so severely that there just isn't enough money to go around, which would be the complete opposite of where we are now. I think it's going to be very hard to overshoot rates. Look at 1982, where rates hit, I want to say close to 21%. By 1981, 1982, they were close to 21%. You could have gotten a 6-month CD for 21%. And that was what was used to kill inflation at that time. But the Federal Reserve didn't have a lot on its balance sheet then. Didn't have that tool to use as far as it didn't have that tool on its balance sheet in order to reduce the amount of money that's flowing around the economy. So I don't know where that calculation would be right now. And we are again in uncharted waters. When Paul Volcker decided that he was going to raise interest rates in 1982 north of 15%, that was uncharted water for the Federal Reserve. They were not actually sure that this was what was going to work, right? And what resulted was that we exchanged high inflation for high national debt, like high interest national debt. That was literally the choice that was made. Is that and the reasons for inflation back then, in that case, were very different than today, and a lot of it had to do with the fact that foreign governments were pegging their currency to the U.S. dollar, and they were doing that by keeping massive actual physical quantities of U.S. dollars in bank accounts in foreign countries. That's how you pegged back then. And that literally caused a shortage of actual physical dollars in the United States, and the government had to print more. And they solved that problem by making U.S. debt a more attractive option than holding cash, making U.S. debt a way to peg currencies to the U.S. dollar to stabilize your own currency. So that, to a degree, is still happening today, meaning that sovereign wealth funds all over the world, because the U.S. government has never failed to pay on its obligations, basically debt has been a better investment than the U.S. dollar itself. That's not likely to change, especially if interest rates are rising, in the fact that we've never failed to pay on our debts. So about $9 trillion of our debt is owed to foreign governments. About $9 trillion of it is owned by the Federal Reserve, and the rest of that 11 or 12 trillion or so is owed to investors here in the United States. So that situation is probably not as dire as people, particularly in conservative media, would have you think, but in financial media as well. So that slice, how the ownership is divided up, is actually fairly diversified. So see, in high inflation, is there a way to reduce U.S. debt? I assume what you're saying. How are they going to address this problem? So balance sheet roll off is one of the ways that they're going to reduce debt. So the Federal Reserve is going to allow the bonds that they have simply to mature, right? And then they're going to sit on the cash, meaning you buy a bond for $1,000, it pays you 5% interest, but because interest rates were super low at the time, your $1,000 bond that you bought, you really paid $1,200 for. So the interest rate, your yield to maturity, is a lot lower than that. So now those bonds are coming up for maturity. The Federal Reserve is going to get all that principal back. They're simply not going to spend it. They're going to sit on it, right? And when the economy turns around or it needs to be stimulated, they're not going to drop interest rates like they did in the past. What they're going to do is probably buy bonds back on the open market again in order to stimulate the economy. I don't think that's the best idea. That's, if you look in the beige book, that's kind of their plan for things going in the future. I don't think that's the best idea. I think they should take that cash and simply burn it, like literally just burn it. Just like Paul Volcker did in 1982, where he literally shredded and burned piles of U.S. cash to reduce inflation. Now, this is done in a different way today because it's mostly electronic entries, but that's kind of what's going to happen in this case. But no, is there a way to reduce debt at this point? We will not see a reduction in debt anytime soon. We're not going to see a reduction in debt until we see a very brave, technocratic administration that's elected that works in coordination with the Federal Reserve to have a period of austerity and reduced debt. We've never elected anyone with the balls to do that. Never once in this country have we done that. Someone who's willing to say, "I'm going to sacrifice the current economy for the future of this country," which is something that would have to be done. It would cause massive unemployment. It would cause massive social unrest, but it may be what's actually better for the country in the long run. Do you know anyone who would be willing to take that risk today? So I am of the opinion that we probably should have gone into the natural end of this current credit cycle should have been in 2018. We should have gone into a recession then, and the administration decided to spend money like a drunken sailor. They basically added $1 trillion of debt in 2018, 2019, before the pandemic started, in order to prop up the economy, which I think was a mistake in the long run. In the short run, it made everyone feel good. In the long run, it's creating more problems. So Apple still has a stack of cash on the balance sheet. Do they deploy that to invest in fixed interest at the time and make some passive earnings? Yes, they're always doing that. Interest rates on the short term, though, are still fairly low. Look for a return of commercial paper going forward. This is a market that has been propped up by the government for years. I used to do a lot of business in like short-term 30-day commercial paper, overnight commercial paper. Look for a return in this market here in the short term, and for some money to be made trading short-term debt instruments. So Patrick Mulligan says, my first mortgage was 17% interest in 1988. So I didn't buy a house back then, but I remember my parents' interest rate on their home was about 16% in that. Yeah. And Stephen Kua says, the first house that I bought in 1989 was at 12%. Yes, I think we are headed back to these sorts of interest rates, maybe not at 12%, but I would not be surprised to see interest rates on a home by the end of 2023, 24 being at close to 9%. And about 50% of people who work in the real estate industry will be not working in the real estate industry then. They're going to have other jobs somewhere else. You're going to see, once again, when the tide goes out, you're going to see who's swimming naked. Real estate agents who have been in the business for less than 5 years and don't have a spouse to support them or something like that, you guys are going to be hurting here pretty soon. Unless you have a grand strategy. There was a guy here in San Diego County who, when the crisis in 2008 happened, he spent millions of dollars on advertising. I don't know where he got his funding from, but he bought up everything that you possibly could in the San Diego area, sat on it for a couple of years, and then ended up selling it for a massive profit. And I think some of that's going to go on to, we're looking probably at a pretty good opportunity here in real estate going forward. A lot of folks are saying that people are sitting on houses. There's no, I know a lot of people in the real estate industry who are still remarkably positive about what's going on, but they just don't understand the math behind the cost of ownership at this point, and the fact that the market is going to break at some point. We're going to be seeing people who are short selling homes again. We're going to see an uptick in repossessions, home repossessions, and evictions, and that sort of thing. And we are going to see some opportunity here going forward. And I hope the folks watching this live stream are the ones who are able to take advantage of opportunity. So, anyway, folks, it is the lines are open here. If you Eric M says strategic petroleum reserve. Yeah, that move is just for publicity, Eric. Never in the history of releases of oil of the strategic petroleum reserve has that ever resulted in anything other than making people feel better, or making people feel like the government is doing something about what's going on. Releasing 1 million, we use, I think, 9 million barrels a day. So a release of 1 million barrels from the strategic petroleum reserve does nothing to affect the price of gasoline at the pump today. Absolutely zero. With current issues with supply chains, which will be a factor in driving up inflation, are we too reliant on others and should build and grow and produce ourselves? So that's always the case. But one of the things that has reduced global conflict between major players in the last 50 years or so has been the fact that our economies are pretty richly tied together. Since 2014, Russia has been excluded from global markets in a large way, and that's part of what made them more likely to go to war to begin with. But if you look at conflict between the United States and China, from a business perspective, I think this is actually fairly unlikely. And there would be, I think we're going to have diplomatic conflicts. There's going to be some saber rattling. I think we may even see like small actions here and there. But the reality is that we aren't likely to see conflicts because we do so much business together. I think though that we should shorten our supply lines for a lot of different things, and I think that's happening naturally anyway. The I think it's happening naturally anyway. There are a lot of things now that it makes more sense to manufacture here than it does in China, right? And Tesla has gone a long way towards proving that. Hold on a second. Tesla itself has gone. Tesla has changed the way that people think about manufacturing in the United States and manufacturing worldwide, and I think that's super impressive. And so I'm very excited about where we see this sort of thing go in the future when it comes to supply chains. Yeah, but we're still going to have a global economy. There's always going to be a reason to have a global economy, and the global economy for humanity in a lot of ways has been better. It's reduced conflict, right? Which conflict is war has no longer become is no longer business profitable like it has been in the past. Wars in the past a lot of times were fought over control of resources, trade routes, and that sort of thing. And we don't necessarily need to do that now. That's all going to be more disruptive than it's actually worth. So, do you think mortgage rates could stay high for a very long period of time? The answer is yes. The answer is yes. So I did a video a few weeks back on inflation-induced debt destruction, which is not a term that I came up with on my own. This is a term that somebody I probably saw in a newspaper article years ago or read on a blog somewhere years ago. But we are looking at going through something like that here in the future. Long-term inflation, if you can change jobs and work your way up that income scale, and this is the thing, it's long been the truth that the best way to get a raise at your job was to simply go find another job and make them match the offer or leave. Nothing is going to be more true than if this period of inflation is seriously going to be sustained. Be prepared to switch jobs for a better offer. They're going to be out there. And while you're doing that and you're working your way up the income chain, if you already own a home and your interest rate is fixed at 3.5%, you're looking. This is the reason why my parents bought a house in 1968 in South Carolina for $20,000 or something, and their mortgage was like $75 a month or something, and that house by 1990 was worth $500,000, right? They didn't do anything special. They went through inflation-induced debt destruction. That $19,000 mortgage they had on that house was virtually worthless by 1990, all because of inflation, and because that their expenses, their housing expenses were fixed. They were able to use that money to invest in all sorts of other things. That is going to happen with everyone right now who has a fixed cost of housing. The proportion that you're spending on your housing is going to decrease and decrease and decrease, even as the proportion that you spend on food and fuel increases. It's probably not going to increase faster than your increase in earnings and the fact that the proportion of what you're spending on housing is not increasing at all. So if you think that inflation can only be bad, it is not bad if you have fixed interest rates on your housing and fixed housing expenses. My cost of my mortgage right now on my home is far less than what I would need to pay for a 2-bedroom apartment in my city. Far less. I think that's absolutely shocking. And it's only been 8 years since I bought this place. And so this is a 4-bedroom, 2-bath house in San Diego. I'm paying less than what you'd pay for a 2-bedroom apartment to rent. And so it's already happening to a degree that my housing expenses have outrun, basically housing expenses have outrun my house to where now I don't think I can afford a 2-bedroom apartment in this city. Nathan W says, do you have a family member? Do you have a family member? Yes, I do. And then I lived in Belgium and in France for a little while. So, and traveled all around Europe. So I speak fluent French and I speak okay Spanish just because I've lived close to the border most of my life. And I haven't really even tried to learn to speak Spanish. I just happen to speak it fairly well. Like when I went this time down to Colombia, I was really trying to learn to speak in past tense, things like that, because I have problems conjugating the verbs. and I had a great time, man. If you guys haven't been to Colombia, I highly suggest you go. There are so many things to do there, so many things to see. It's a country that's really sort of emerging and finding its own footing on the world stage. The people there are genuinely super friendly, willing to start conversations if you speak even a basic amount of Spanish. So, yeah, I had a great time when I was there. But yeah, uh, fire away, guys. Any other questions here? I'm going to look back and see if I missed any other questions here. Oh, back to Apple. They have over 700 million of cash, with 700 million inventory, and the market value is less than 150 million. Market T, which company were you talking about here? Was this Apple? Somewhere else. So, yeah. So people can reduce spending elsewhere, but we need to eat, power homes, and put gas in the cars. For me, the federal government may need to do more. Um, True. So the answer to that in the past was price and wage controls. Um, I'm not sure that that's possible in today's environment, in today's political environment, either in Europe or in the United States. I don't believe that the government could actually impose price or wage controls. They did that after World War II. They did that prior to the Korean War. They did that after the Korean War. They did that in 1968. They did that in 1973. Right. I don't know that any government today has the willingness to do that, because the first thing that's going to happen is everyone's going to call them socialists, which it is a policy that I think oversteps the bounds of the federal government here in the United States to impose price and wage controls. But I do think that, and it's been used many times in the past, I don't think we have the political will to do that today. And I'm not sure that I wish we did. I'm not sure that it really solves all of those problems. But this statement right here, for me, cash is king at the moment. It is completely the opposite of that. Cash is absolutely trash. You are losing about 1% purchasing power per month on your cash as it's sitting there. You are losing money and purchasing power as we speak. You kind of have to be invested at this point. And investing when things seem the darkest is the best way to go. That is absolutely the best way to go. Yeah. Let me see here. Any other questions here? Sheila's Joe says, where did you stay in Colombia? I went to Medellin and I went to Cartagena, and Medellin was awesome. Cartagena took me a little bit of getting used to before I figured things out and figured how to get people to leave me alone while I was there and just hang out on the beach, have a good time. I did like a bunch of island tours when I was there too. Ate a lot of really good food and had a great thing, and I had a great time. It was one of the best vacations I've ever taken. So, Eric M says, over the last 25 years, previous bear markets only reversed when the Fed made a dovish pivot. Sure. But I think the dovish pivot in this point is actually going to be asset purchases when they actually need to do that. I do think that the Fed is going to miss the mark here, and we are going to go into a mild recession. And I do think that the pivot this time is going to be next time is going to be asset purchases, because they're going to have room in the balance sheet to do that. And they're going to have cash in reserve. They're going to let all of these bonds at roughly, I don't remember the amount, but I think it was like $120 billion per month is rolling off their balance sheet right now that they're going to be getting in cash. They're doing that through the end of the year. Basically, by the end of the year, they're going to have close to $1 trillion just sitting in cash. When they want to do that dovish pivot, it's going to be in the form of asset purchases, simply because they want to still have those interest rates in reserve in order to make that dovish pivot and cut interest rates if things get really bad at some point. Like right now, if we actually had a giant crash in the economy, like a 2008 style crash, their only choice is to print more. Right? They don't have interest rates to use, like really. So I think that they want to build up their weapons inventory going forward, and I think that's probably the smart way to do that. So, can you share an idea on the cruise sector? And yeah, so this is something I've had conversations with on the cruise sector before. Traditionally, the cruise sector was a huge dividend payer, and they really haven't been for a very long time now. And they're all sitting at 52-week lows. I think that the biggest scare for the cruise industry right now, the biggest thing with the cruise industry right now is just fear. People are worried about asset pricing and they're not booking cruises. I think at some point, even if inflation is on the rise, that actual fear is going to dissipate to some degree as people accept inflation and they're going to start spending money again. So yeah. Let me see. Tech will take 80% of jobs in the 15 years, and learning the code will not help. Rocket and Rockwell tooling is now 3D printed. Auto driving is only data crunching. Is okay. Insurance for the rich. Okay, I'm trying to get a point out of that punched board or countersunk. Which, by the way, I like your handle there. Here we go. And John, your test actually works. And Eric M says, how long does it take you to learn a language? It kind of depends on what it is. Because I have a pretty good base. I can understand bits and pieces of probably about a dozen different languages, but there are a couple of guys on YouTube, man, where they can learn a language in about a month. So here's how, one of the ways that you learn a language really well and retain it is that when I'm studying Spanish, I'm actually studying it from French, right? So I'm using a French to English or French to Spanish translator because I don't speak French regularly anymore either. But I can speak Spanish regularly if I choose to. I just have been too lazy lately, but I'm dedicating myself to speaking it fluently. But when I'm using my translator, I use it French to Spanish. That way I'm still using the language that I don't use as much, and now I'm translating it. So that's probably one of the better ways to do that. Like as you're learning Spanish, go ahead and start learning another language. Make sure it's completely unrelated, right? So like learn Spanish and Arabic or something. And well, they're not completely unrelated. About 30% of the words in Spanish are actually borrowed from Arabic, but the syntactical structure is completely different. So, but I would use a Spanish translator to learn Arabic as well. And that way you're reinforcing both languages at the same time. And this is how a lot of those really incredible polyglots do this. And I know because I've spoken to people that speak 12, 13, 14 different languages, and this is how they learn them. And you should learn the basics of being, so your first language is really tough. It's going to take you about a year to, at a minimum, to learn how to just carry on a basic conversation, right? And as you go forward, though, you should be able to learn the basics of conversation in about 3 months. Yeah. So would another lockdown put us in more trouble than we already are now? Yeah, there's not going to be another lockdown. And nobody has. So lockdowns were maybe not a great idea to begin with. They didn't have any other planned response for that anyway. So, and I don't necessarily blame politicians for coming up with lockdowns. Nobody knew how bad this was going to get. It's worse than in opinions on how bad it was are divided by your political affiliation. But if you look at the amount of people that died, it's actually more than the Spanish flu at this point. Did the lockdowns help? They probably didn't help because not enough people actually took the lockdown seriously. It wasn't done uniformly across the country. But I'm looking at the other extreme, like Australia at this point, and I'm saying, was that the right thing to do as well? Or looking at something like that, was that the right, or looking at New Zealand, was that the right thing to do? I think that Japan's response was probably ideal. Taiwan's response was probably ideal. I don't think that those responses would work here in the United States. You just couldn't get people to go along with it. You couldn't do it in Europe either. So, yeah. But I do think that Japan, South Korea, and Taiwan, they had different responses, but those responses were ideal. They reduced mortality. A lot fewer people died. And they were able to keep from crashing their economy, keeping unemployment low. And Japan is actually not facing, they're facing inflation pressures, but nowhere near what we are at this point. But every country in the world is facing inflation right now, from Slovakia to Poland to Turkey to China to Australia. Everyone's facing inflation right now. This is not a localized problem that only the Federal Reserve can deal with. It's going to take a worldwide effort to do this. So, owning your house means that you are targeted to be fleeced because they will be the only people with money and essence to be rich, and you have to pay for them. Okay. I'm not sure what your point is with that. I'm really not sure what your point of that. Something like 63% of people in the United States own their own home, 63 or 64%. We have, so I don't know if that makes you a target to be fleeced, and everyone's going to be a target to be fleeced. They're going to be the only people with money. It's expensive to be rich and you have to pay for them. Yeah, I'm not sure what your point is with that. Feel free to elaborate and I'll address that. But Um, we can go back to that if you want to and talk about the benefits of inflation for people that have fixed housing expenses. I mean, if you have a mortgage on your home, you bought a home for $500,000, you put $100,000 down, you have a mortgage. Let me see here. YouTube is censoring some words. I can't get my words through. Hey, I have a curse word filter on my YouTube. Crypto. Huh. Interesting. Like it shouldn't be filtering any. Oh, so John, there's actually a little bit of a delay between the comments that I see using this software that I use in order to do live streams and then probably what you're seeing, right? So there's probably a significant delay in those. So it might take me a minute or two to actually see. Crypto.com. Oh, yeah, it's you can't put links in my comments because people were using it to they were all my live streams putting links into porn sites, and the only way to block them was to block putting any sort of URLs in there. So when we talking about crypto.com, are we talking about I've been out of the news. I've been out of the loop here in the news for about 2 weeks, John. I've been on vacation in Colombia, enjoying the hell out of myself and having a good time. You know something? It was nice to be disconnected for a while, but I do want to address the fact that we are in a crypto winter at this time. I don't know how long it lasts, but crypto at this point is really, really decidedly correlated to the NASDAQ at this point. And it's really highly correlated to young male employment and highly coordinated to the NASDAQ. It shouldn't be. And I think that at some point, crypto starts acting like its own asset class. Right now, it is not acting like its own asset class. So right before I was gone, we had the collapse of Luna, we had the collapse of Terra and that sort of thing. And then I know that while I was gone too, there are a couple of platforms that actually prevented money from being taken out of the platform to avoid collapse or a run on the bank. And these were lending platforms. What we're going to see out of this, folks, is more regulation. I would like to see regulation of stable coins, but I would not like to see regulation of many other parts of the crypto world at this point, because I think it's going to suppress innovation. And I think it's important that we don't crush innovation in this. So, Japan debt is 200% of GDP. We have 100%. What do you think the long-term outlook of us? So the ownership of Japan's debt is very different than ours. The vast majority of Japan's debt is actually owned by their own citizens. I mean, it's owned by pensioners. And it's because they had a massive program to encourage people to save and invest in their own country. And so it's a very different situation. Like they don't have $9 trillion being owned by foreign governments. They don't have it being owned by their central bank. Most of it is owned by people who are saving for retirement and who want to see those interest payments. And when you want to talk about low interest payments, I've actually seen Japanese people get excited over 0.1% on a bank account that they're making. Right? That's how the interest rates have been seriously low since like 1991 or 92 in Japan. And Japan has massive issues right now with maintaining their population. Their population is just not reproducing enough. So much that they're allowing they're finally for the first time allowing relatively unrestricted immigration of certain populations into Japan. So yeah. What do you think about Unity software right now? Well, I have not looked at Unity software for a couple of weeks because I've been on vacation. So, and I'm going to say when I look at it, it's probably going to be terrifying. So when I left, it was like $40 a share. Today it's at 32. I will be buying Unity software. That is a guarantee. I think that Unity software as a platform it's too good to pass up at this point. Their opportunities for revenue are too varied. Their execution on their business is going really well. And here's the reality of being a software developer. And I know this because I was a software developer at one point. Out of 100 software developers, 99 or one of them is going to be really excellent, right? One person could actually one team of people, or one person could lead a team of people to recreate the platform that Unity has created, and they could produce a pretty good product. But 75% of the developers that you talk to are actually going to be not very good at all and really not worth what you're paying them, and the other 24% of them or so are going to be relatively mediocre. So literally about 3/4 of software developers really aren't that good. And like I said, they're not really. I don't think they're worth what you pay them. And I think that we're going to go through another one of those periods where we see a washout of mediocre software developers. And I don't know that there's a cure for it. I couldn't find a way when I manage software developers and I manage like data analysts. I couldn't figure out a way to make a bad analyst and a bad software developer a good one. I could not figure out a way to do that. I tried educating them. I tried showing them possibility. It was a matter of creativity, and you've either got it or you don't. And I think you can develop creativity when you're really, really young. But I worked with a lot of older developers when I worked in finance for the government. These guys were in their 50s, and it was impossible to teach them to now be innovative and creative. I don't know that it's impossible to teach a younger person to do that, but I could not make a bad programmer into a good one when I was a manager. Maybe that's a failing as me as a manager. I don't know. So, do you think they will survive the bear market? Their massive ad expenses, New Year's volumes dropping. You're talking about crypto.com and the cash flow. I don't know that they survive a bear market. I think that some of the bigger platforms out there, I don't know that they do. And what do you mean by survive? I think they end up probably getting bought out by Coinbase or something like that. So, or by something. And what happens if they burn all their cash? Well, they go out of business and they have to declare bankruptcy, just like Electric Last Mile Solutions declared bankruptcy. We are going to see that. This is the tide going out. Now you get to see who's been swimming naked the whole time. Yeah. The point is, our leader not planning for the future. I was a toolmaker for 35 years, and tech has de-skilled it to boredom, and now it's set up as a party for the rich. Punch, border, countersunk. The reason I liked your so you have a guillotine in your photo, which if you have a guillotine in your photo, that would tell me that most of the time that you're probably a leftist, which maybe not if you're a toolmaker. But punch, border, countersunk. I really liked your handle there, just because I like boat building as well, and it's a skill that I have that can't be de-skilled to any degree because it's so custom. I tend to agree with you though that tech is de-skilling a lot of the work that's being done now into boredom. But that has been a feature of humanity since the beginning of civilization, is that all specializations that were once highly valued eventually lose their value. And if you don't evolve, you will die. Think about this. For thousands of years, the ability to read and write was reserved for the wealthy. Right? If you think the wealthy could read, but you could not get them to write a document. You had to get a scribe to do that, to write it in flowing cursive or calligraphy or whatever was done. And they were highly paid professionals to do this. And typeset, invented by Gutenberg, put them all out of business in about 100 years. If you look at shoemakers in the 1790s, where the word sabotage comes from, right? It's because there was a machine, I can't remember the guy's name, but he essentially built one of the world's first computers in order to produce cloth. And the Dutch peasants at the time, they threw their wooden sabot, which was their shoes, into the machine to destroy it, and that was sabotage. I think this example was actually on Star Trek at some point. But anyway, that's the history of innovation. Every skill, if it's expensive, eventually gets de-skilled. Even skills that aren't expensive, that are troublesome, like checkers in a supermarket, that eventually gets de-skilled as well. And because they're unionizing, that's going to get de-skilled as well. This is why we have self-checkout lines. This is why when you go to a Walmart, you're both customer and employee of Walmart. You're doing part of their job for them. So yes. Do you have a rule for savings to investment ratio? I have 30% in savings and the rest in investments. I guess it's down to my risk tolerance. So I do have a rule when it comes to savings. And this is an extreme rule. And this has to do with the fact that I never want any sort of, hold on a second. I'm going to shut my door real fast. Yeah. So I do have kind of an extreme rule when it comes to the amount that I keep in savings. So I generally keep about 3 years of living expenses, not income. And my living expenses are far below my income at all times. And it doesn't matter how much I earn. If I earn less, I spend less. That's simply the way I am. Um, so I keep about 3 years of living expenses in cash. Why is this not a mistake? Because I am never going to make this mistake. I'm never going to take short term discomfort and make a decision that affects my portfolio on a long term basis. 3 years is about the time I need to outlast any and all irrationality in the market over. I mean, you could call that wrong too, right? Even 3 years of living expenses, but there's very little chance that I'm not going to find some way to earn money in a 3 year period, even if everything goes to crap. So it depends on really if you're at a beginning stage in your life right now where you don't have at least 6 months of living expenses saved up somewhere. And put it this way, I don't consider that an investment. That's losing purchasing power. Like I've actually been adding a little bit of money to my savings account lately just because I realized that what was 3 years of living expenses in 2019 is not 3 years of living expenses in 2022. It's gone up a little bit. So based on the fact that my housing expenses are fixed, my overall expenses for my life have literally only gone up about 11% in the last 3 years, right? And almost all of that is due to my medical expenses going up. It's not been gasoline and food. Yeah. But yeah, so I don't have a hard and fast rule for that other than the fact that I keep 3 years of living expenses in cash at all times. And the rest, and while I'm at that 3 years living expenses cash, every dollar else that I have is going into a long term investment portfolio, every single dollar. So I started setting myself up for retirement in my mid 20s. Right. I did my first investments earlier than that, but I didn't start my real long term thinking until in my mid 20s or so. John says, "Do you think they will survive the bear market like their?" Oh, okay, we already covered this question. All right. Inflation helps government debt more than devaluing valuing public debt. So, punch board or countersunk. You, I'm gonna need a little help here in clarifying your questions at some point. So, the whole point of government debt is actually using inflation, right? That is the entire point of issuing government debt, is that I'm going to give you a nominal amount of interest. If I'm the government and you borrow money from me, let's say you buy $100,000 bond from me, right? The price and the interest rate on it when I sold it to you was at 4%, right? So I'm going to give you $4,000 a year on that. At the end of the 30-year period, when I pay you that money back, I know that it's been devalued on a compound basis over the last 30 years by roughly 2.44%. So that fixed 4.0% interest that I was paying you on that, or 3.0% interest, versus that 2.44% that I want inflation to be over that 30-year time period, means that I'm paying you back less money in terms of your actual purchasing power than you ever got from me. That's the whole point of government debt, is you're trading security, right? You're buying security when you buy government debt. You're not buying an incredible investment where you make tons of money. That's not why companies or individuals or countries buy our debt. They buy our debt simply because we always pay on our obligations. And we sell the debt because we're going to pay you back in dollars that are devalued over the course of 10 to 30 years. That is the entire point of that, is that the Federal Reserve has a target interest or target inflation rate of between 2 and 3%. So we get to pay you back in dollars that have been devalued over a 30-year period. That's how the game is rigged. Everyone knows it. That's how it works. Okay. This is why debt is not the terrible thing that people think that it is if you're a government. Okay. On the individual basis, of course, we can't run our lives like that. But no, inflation does help government to a large degree when it comes to managing their debts as well. So, yeah. So inflation is not all bad at all levels for all people. It certainly is not. Yeah. And that's something you need to consider going forward. You may have particular advantages in this market and in this environment that you don't realize, particularly if your housing expenses are fixed. And especially, like, I have an interest rate on my home here. It's like a 3.25% or something like that. I'm never going to be able to refinance it now at this point, never in my lifetime. But my housing expenses are fixed at what's lower than rent for a 2-bedroom apartment in my city. You know. All right, so I just got a text saying, please again say what beer you're drinking. This is Electric Cruiser, which is very appropriate for my channel. Electric Cruiser by Green Flash. Green Flash, if you're not familiar with them, it's a local brewery in San Diego. By the way, if you've never been to San Diego, my bar, Good Bar in Point Loma, just sort of won a recognition in a magazine. It was printed up stating that we have the best selection of local beers in all of San Diego County. I don't know if my business partners paid the people to print that or not, but I'm just kidding. But it's very nice that our efforts are being recognized. I actually wanted to give a shout out to my partner in that venture. If he ever watches my live streams, man, I really appreciate you. You've done a great job of putting everything together when it comes to that. That bar was not operational for 2 years. We were shut down between March 16th of 2020 and March 12th of 2022. We were shut down for 2 years. At any point from September of 2021 until we opened up, there was a good chance that we were not going to make it. And we are now. And I'm extremely happy with that. And things are looking pretty good. And he and I were discussing this yesterday, that kind of doesn't matter what the economy does. People are ready to go out and enjoy themselves, have a good time, have a drink or two, and socialize. So if you're in San Diego, it's Good Bar in Point Loma. It's on Rosecrans, 1872 Rosecrans. There we go. IPAs and porter beers are the way forward. I treat beer like other cultures treat wine. I think that yeah. So Hal says, congrats on business success. I don't know how you mix all these things in an 8-hour day. So honestly, the trick is to really lean into whatever whatever creates my neural atypicalness. I just kind of have leaned into it. I can't do anything full time without getting bored with it. The only thing that I seem to really enjoy is doing YouTube videos, especially doing live YouTube videos, and surfing, of course, and jujitsu. But I can't do any of those full time and like them, or it eventually become a job. So I have to like do little by little. So I guess I would be ADHD or something like that, or whatever it is. But that is what makes me happy, is doing something different every single day to promote one of the businesses that I'm involved in. And yeah. So, but thank you. That was a long road towards getting on solid footing with that business, and it looks like we're on solid footing. So if you guys are in the San Diego area, maybe I can arrange something with my business partners. If you guys are subscribers to my my channel, that you guys can get a discount on whatever you spend at Good Bar in Point Loma. Anyway, folks, it has been an hour and a half today. This has been one of my longer live streams. I've had way too much beer now, and I am going to close out this live stream today. And Leo Wu says, hey, I hope you had a great vacation. I had a great vacation. You missed a lot today. I'm going to be on Monday. I'll be back when it comes to a live stream. All right, folks. So I will be back on Monday. I think today's Thursday, right? Yep. Today is Thursday. And yeah, any other YouTubers you like? There are other YouTubers I like. Tom Nash is one of the YouTubers that I like quite a bit. I don't watch as much of his stuff that I could. And also Invest with Jace is someone that I like too. He's a good dude. I've never really, and there's also Becoming Financially Fit. In fact, I need to contact Stacy so we can get back on and he can do a live stream with me and we could talk about some stuff. But anyway, folks, thank you for the super chats. Thank you for watching me again. And I will see you guys on Monday. Bye.